The value of US dollar has been constantly decreasing over the years. What a 1950 you could buy for $1, today in 2021 would cost you about $10.80. And the reason for that is the constantly increasing supply due to the fiscal policies of the Federal Reserve. That means that anytime the government needs money, they just take out good old printing machine and start printing more, like recently with the COVID stimulus checks. And that led to the inflation rising to the very high level since the beginning of the century and now reaching 6.8%. When we think of cryptocurrencies like Bitcoin or Ethereum, the price has been very volatile throughout the years. And when the investors need a safe refuge from all this volatility, they oftentimes swap these cryptocurrencies for stable coins such as USDC or Tether, which value is pegged to US dollar, which means that you can swap one stablecoin for one USD. And currently these stablecoins are number 4 and number 8 by market cap, which tells you that the investors hold significant amount of these stablecoins. But here's the problem. Since these stablecoins are pegged to US dollar, it means that their value depreciates as the inflation rises. And that's when DAO was invented, to solve both central decision making and the depreciation of the stablecoins. Hi, my name is Oleg, and in today's video we're going to be talking about DAOs, how they work, what's the purpose, and how you can benefit as an investor in crypto space. DAO stands for Decentralized Autonomous Organization, and to put it simple, it's a computer program written by a group of people that maintain it and represent a DAO, but controlled by its members. And what I mean by that is that the community of token holders get to decide what decisions to make based on open voting. And that way the decisions are made by the community or bottom up and not top to bottom, like in case of central banks where they make authoritative decisions where no one has a say. In this example, I'm going to be talking about Hector DAO because I really like this DAO and I really like the honesty and work ethic of the team. And they're not the first one to start this whole DAO movement. The pioneer is going to be Olympus DAO, and they're still the largest by the market cap, sitting at over $2.7 billion in market cap right now, and they're still offering crazy high APYs of over 5,000%, which not a single financial institution can offer. The only problem that I have with them though is that they're built on Ethereum blockchain and the transaction fees are really high, sitting at around $50 to $70 at the moment, and unless you're handling large amount of money, that doesn't make sense to spend that much, especially when you need to swap the token all the time or you need to pay for the staking transactions or unstaking transactions. That's why I prefer Wonderland or Hector that are built on Avalanche and Phantom networks respectively, that have way lower transaction fees that cost a couple of cents at best, and they offer higher transaction speeds. So let me try to explain how DAOs are changing the crypto game and how you can benefit from it as an investor. So going back to stablecoins, since we already know that their value depreciates as the inflation rises, Hector issued their own coin called HEC that is going to serve as a free-floating reserve currency backed by assets for Phantom Network. And the difference here is that it is backed by assets and not pegged to US dollar, but it's still a free-floating currency, which means that the price is going to change based on the supply and demand for this currency. But the price is going to be more and more stable the bigger the protocol grows, and it has a lot to do with liquidity and the fact that DAOs own most of their liquidity. Well, then you might be asking, how's it gonna guarantee any value if it's a free-floating currency? And it's gonna get a little bit more clear once I explain how DAOs work and how it creates value for investors. First, let's talk about liquidity and why it's important. In the most simple term, liquidity is how many items of something is available. So let's say that you go into a grocery store and you want to buy apples. If the store has 10 apples, it means that the store is 10 apples liquid. Now let's say that they sold 8 apples and they only have 2 apples left. Now they're left with 2 apples of liquidity. That means that hypothetically, if no other conditions change, they can technically charge more because the supply is decreased, but the demand is still staying the same. And the same is with the cryptocurrency. Somebody who owns the cryptocurrency has to provide this crypto for trading, thus supporting the liquidity. And I'm not talking here about the centralized exchanges such as Coinbase, Gemini, or Binance, because these exchanges provide their own liquidity, which means that they buy these tokens from the blockchains and then you as a customer buy from these companies directly. So in other words, it defeats the purpose of being decentralized, but all these exchanges are still important because anytime you need to exchange your crypto for fiat currency such as USD, British pound, or euro, you can go ahead and do that with all these exchanges. But here I'm going to be talking about the decentralized exchanges where you can just exchange one crypto for another. And in this case, let's just take an example of Pancake Swap. When somebody goes to a Pancake Swap and they want to buy or swap, let's say, Dogecoin for USDC, then Pancake Swap needs to have liquidity for that. So the third party needs to go ahead, somebody who owns the pair of USDC and Doge, and then they provide this pair of USDC and Doge through the process called farming. And for that, anytime somebody goes ahead and swaps this pair, they get paid interest with the same pair that they provided. So what that means is that they provide liquidity, and there are multiple liquidity providers for decentralized exchanges. And what that also means that anytime they can decide to withdraw, hypothetically, and reduce the amount of the liquidity pool. And the smaller the amount of the liquidity pool, the higher the chances for owners of the large amount of tokens, also known as whales, to affect the price, especially if they try to sell a huge amount of tokens which represent a huge percentage of the liquidity pool, then it can drive the price down. That's why it's important that the liquidity pool is big enough. That way, a single holder that has a significant percentage from this liquidity pool cannot affect the price negatively. And that's why DAOs are revolutionary, because they own most of their liquidity, and the bigger they grow, the bigger the liquidity pool gets. That way we know that whenever we go and trade, we always have the liquidity to trade, and that way we know that the price gets more and more stable the bigger the liquidity pool grows, because DAOs own their own liquidity. And this is a completely new idea for the DeFi 2.0, where the protocol owns its own liquidity. The bigger the protocol gets, the more stable the price of the token is going to be. And Hector owns almost all of its liquidity, sitting at 99.84% at the moment. Another benefit for the protocol owning the liquidity is that anytime somebody goes to an exchange and swaps the protocol token for something else, they get paid all those transaction fees, and these transaction fees comprise a significant amount of a protocol's revenue that also go into backing the protocol's token. Have you ever seen 3,3 meme going around the internet? Well, let's talk about this and how you can invest in a DAO. And the two ways that investors participate in a DAO is through the processes called staking and bonding. Staking allows you to earn passive income by locking up your HEC, and you get paid in SHEC, which stands for staked HEC, through the process called rebase, which in case of Hector happens every 8 hours. So every 8 hours you get paid interest on your investment. And the APY is currently sitting at just under 70,000%, which is mind-blowing, and not a single financial institution can offer. Even on the best savings account, the best you can get if you're lucky is 2.5% interest. Bonding is the process of swapping selected tokens, and normally this is stable coins such as USDC, Frax, or a DAI, or liquidity pairs such as Hector with the all above mentioned stable coins. That way they have the assets in the treasury and they can provide their own liquidity, because they get liquidity pairs paired with Hector to support their own liquidity. And when investors buy these bonds, in return they get discounted HEC that is vested linearly over the period of 5 days. And what I mean by that is that every day they can claim 20% of their HEC that they're supposed to get, and after 5 days of vesting period are over, they get the full discounted HEC. Bonding is the primary source of revenue for the protocol, and that what allows it to own its own liquidity as well as back their token with assets such as DAI, USDC, or Frax that they have in their treasury. And that is why HEC is called free-floating currency backed by assets, because it's backed by all these stable coins in the treasury. To make it easier to understand, let me explain it with real numbers. But first, you need to understand that the protocol guarantees one price of HEC to be equal to one DAI, and DAI is a stable coin that is basically equal to $1. So that means that anytime the price of HEC falls below $1 or one DAI, the protocol is going to use all these treasury assets to buy back HEC, thus reducing the supply and driving the price of Hector back up to at least $1 per HEC. So what does it mean for the protocol when the market price of HEC goes above $1? So let's assume that the market price is around $60, and at the moment of recording this video it's around that price, but for the ease of calculation let's just leave it at $60. And the percentage that you get for the discount when you bond depends on the type of the stablecoin that you provide for the treasury, but it's around 8 to 9% normally. So for the ease of calculation, let's assume that it's sitting at 10%. So now at the end of the vesting period, we're gonna get 10% discount on our HEC. So it means that if the price is 60, we're gonna get a $6 discount, which means we're gonna only provide $54 worth of stable coins to the treasury, or $54 worth of the liquidity pairs to the treasury, and we're gonna get 1 HEC at the end of the vesting period. And assuming the price stays the same after the vesting period of 5 days, you can technically sell it if the price stays the same and make $6 on your investment right away. But it's also good for the protocol because all this $54 that they make goes into the treasury, and since they guarantee only 1 HEC per $1, the protocol makes $53 of pure profit on their bonding. And what that means is that now they can support minting 53 more HEC because they're still guaranteeing $1 per 1 HEC, and that's why you can see some crazy APYs for these DAO projects at the moment. And for the Hector DAO, it's now sitting just under 70,000%, which is crazy. And even after a long time, like if you look at the Olympus DAO, the project is about 8 months old. They're still offering over 5,000% APY, which is still crazy. So you can see that it's pretty sustainable. But the more people get in, the lower the APY gets, because now they have to share all this piece of the pie. But the protocol does not just correct the price when it falls below the guaranteed price. There is also a so-called risk-free value or floor price. And currently it's sitting at around $56.45 per HEC. And what that means is basically the value of the treasury assets divided by the amount of outstanding HEC tokens. And when the market price of HEC token falls below that value, the protocol is going to use these treasury assets to buy back HEC, reducing the supply and driving the price of HEC back up. So now that we know about staking and bonding, let's talk about this 3,3 meme going around. So the whole concept of DAOs revolves around the so-called game theory matrix, which is nothing more than a model of possible outcomes between two agents. And Hector's matrix is a little bit more extended because they added 4,4 bond. First, let's take a look at the typical matrix for a DAO, and then I'm going to show you Hector matrix. The columns represent your actions and the rows represent the actions of others, and we have the possible outcomes such as staking, bonding, or selling, because the investors can either stake, bond, or sell. So if you look at the top left corner, you're gonna see that we have 3,3, and that's the most positive outcome because 3 plus 3 equals 6. So when you stake and others stake, that is positive for both protocol and its members because you're locking the supply and you're making it scarce, which creates positive buying pressure and drives the price of HEC token up, which is also good for the protocol because it can increase the liquidity, because now when you bond, the investors are going to pay more stable coins for your HEC token, and that also drives the APY higher. When others stake and you bond, or you bond and others stake, that is also a positive outcome for the protocol because as you can see, it has 3,1 or 1,3, and 3 plus 1 equals 4. So that's also positive because when you're bonding or others are bonding, they're providing liquidity to the protocol, which is good. And when somebody else stakes or you stake, it's also good for the protocol because it locks up the supply and drive the price up, which is also good for the protocol and the investors. When both parties bond, that is still a positive effect for both protocol and investors because as you can see, 1,1, and that's going to be 1 plus 1 equals 2, so that's a positive effect, and that is because the bonders provide liquidity to the protocol, which is still good. Now, when one party bonds or stakes and the other party sells, that is neither negative nor positive effect because it's 1, minus 1, which is going to be equal in sum to 0, so it's neither negative or positive. And when both parties sell, that is the worst outcome for both the protocol and the investors. That way, the price of the token goes down. Now, in case of Hector, and that what differentiates them from other DAOs, is that they provide the so-called 4,4 bond. And if you look at their matrix, that's the most positive outcome that you can get because 4 plus 4 equals 8. And what 4,4 means is that this bond that they buy, they don't get just the regular HEC after the vesting period, but they get the staked HEC, which gets automatic compounds as soon as it's vested. The only problem is that you cannot do it linearly. You can only do it after 4 days. You get it in full and it's automatically staked. And that's the best outcome for both protocol and its members because the protocol gets the liquidity at a discount, and at the same time they receive the staked HEC, which gets locked up and reduces the supply and drives the price of HEC up. Now, does that mean that every DAO is safe? No, it doesn't, and like anything in the crypto space, you should always do your own research. And please don't consider this video as a financial advice or any other type of advice. You should always do your own research. This video is for entertainment purposes only. And the whole concept of DAO depends on the community, like probably anything in the crypto space. And the bigger it gets, the harder it is for it to malfunction because it all depends on everyone participating and staking and bonding for us to see positive returns as investors. That's why when you do your research on DAOs, you should always look for a great community and how responsive the development team is. I know it's been a long video and DAOs are complicated to understand, and for sure it took me a long time to understand what I've been talking about here today, and there's a lot much more to it than that. So do your own research and understand the risks when you do your investments. I hope I was able to make it a little bit more clear for you today to understand how it works and how you can benefit from it. Thank you guys again so much for watching. My name is Oleg, and if you enjoyed the video, please give it a thumbs up to help YouTube algorithm and hit that notification bell to get notified next time a new video comes out. If you like the video and you want to see more content like this, please subscribe to my channel, and I'll see you all in the next one.